Hello, are you there?
Yes,
Okay.
Yes, good evening, sir.
Yeah, good evening. How are you guys doing today?
fine, sir.
Why?
Yeah, you're welcome. So let's start our class for today. So can I remember that last week we could not hold the class. So let's start what we have in front of us today. So where we are right now is for us to look at a new topic called financial instruments. Financial instruments. So by the time we do this class and the next class, we should be done with financial instruments. For us to learn about this standard, we would be using two accounting standards, one of which is IAS 32 on financial instrument presentation, and also is IFRS 9, which is basically talking about financial instruments recognition and measurement. So the financial instrument presentation, this standard will teach us about the objective and scope of financial instruments of IAS of the standard. And also, we will also use this to look at the classification of financial instruments between liabilities and equity. And also, we will use this IAS 32 to look at compound financial instruments. You use it to look at compound financial instruments. Then we would also look at IFRS 9. IFRS 9, firstly, we are going to look at how do you recognize financial instruments. Then we'll look at the recognition of financial instruments. Then we'll look at how you measure financial instruments. It's just these three we are going to look at under IFRS 9. So the first thing I would look at straight is for us to understand what a financial instrument is. That's the first thing I will look at today. And when we talk about financial instrument, IAS 32 is what defines financial instrument to us. And it said that a financial instrument is any contract that gives rise to financial assets of one entity and a financial liability or equity instrument of another entity. That's the definition given by IAS 32. It said it is any contract that gives rise to financial assets of one entity and a financial liability or equity instrument of another entity. Now, let's understand this definition. In understanding this definition, there are three elements here. One is a contract. The second is that financial assets of one entity, financial liability or equity instrument of another entity. Now, let's pick them one by one. For us to have a financial asset, for us to have a financial instrument, there has to be a contract because financial instrument itself is a contract. And when we talk about a contract, what we are talking about is majorly an agreement between two or more parties that have clear economic consequences or even legal consequences. And consequences in the sense that each party must do what they are supposed to do. If they don't do what they are supposed to do, the agreement is enforceable by law, meaning it's either they pay penalty or you sue, but it's a contract and there's an agreement that is legally enforceable or that has clear economic consequences. And very importantly is that a contract does not necessarily even have to be in writing. What is the key thing is that we have an agreement and you have to do what you're supposed to do, because if you don't, there are consequences for that, in as much as you have entered into that agreement. So a financial instrument, for a financial instrument to exist, there has to be a contract. It is a contract. That is what it's all about. Now, this next thing is that this contract would give rise to financial asset of one entity and financial liability or equity instrument of another entity. That goes to show that this contract would have two parties, let's say at least two parties. And one party must have a financial asset. Another party must have either a financial liability or equity instrument, either of the two. So if those two sides are complete, whereby we can see that a party has financial assets and another party has either financial liability or equity, if those two sides are complete, then we are talking about a financial instrument contract. Before we go into examples, we need to understand, okay, when will one party have a financial asset? I mean, what is a financial asset? And also, we need to understand what a financial liability is. And finally, we need to also understand what an equity instrument is. So whatever examples we are giving afterwards will make more sense to us. So let me start with financial asset. IAS 32 said that financial asset is any asset that is cash. And when I say cash, I'm talking about cash in hand or even in the bank. So when you have cash, either in hand or in a bank, the classification of assets in which cash belong is financial asset. So cash is a financial asset. As you can see now, IAS 32 said financial asset is cash. Financial asset is also an equity instrument of another entity. Financial asset is also an equity instrument of another entity. And what this simply means is investment in shares. When you buy shares of another company, if you buy shares in maybe MTN or you buy shares of Dangote, I mean, recently, or the last 2021, when MTN came out with their initial public offer, a lot of people bought into it and became a shareholder of MTN. So when you buy shares in a company, what you have simply done is you have invested. And that investment, the classification of asset it belongs, is a financial asset. So a financial asset is also an equity instrument of another entity, which means that when you invest in shares, when you buy shares of another entity, then you have an equity instrument of another entity. Then the third one is that financial asset is also a contractual right to receive cash. You see, this other one, I'm not going to talk about it because it's beyond our scope here. So the focus is just going to be contractual right to receive cash. You see, when you have a contractual right to receive cash, it means that you don't have to do anything. You would get cash. Money, they have to pay you cash. You will receive cash. Contractual right to receive cash is that at specific date, you have to receive it. And if you don't receive it, since it is contractual, you can sue. You can enforce lawfully that you receive it. And what can give somebody right to receive cash popularly is if you lend people money. When you lend somebody money, you have a contractual right to receive cash because the person must pay you back. Recently, the government issued out some treasury bills. If you had bought some of those treasury bills, automatically, if you had invested in it, you have a financial asset. Why? Because buying government bonds or government treasury bills gives you contractual right to receive cash. The government will have to pay you interest at certain dates. They will also pay you principal at maturity. So contractual right to receive cash is synonymous to investment in debt instrument. Investment in debt instrument. So it's also lending people money. It gives you a contractual right to receive cash. So in this class today, what I need you to remember about financial assets is these three things I've highlighted. Financial asset is cash. That's first. Financial asset is investment in shares, meaning equity instrument of another entity. Thirdly, financial asset is also investment in debt, meaning contractual right to receive cash. Even when you sell on credit, when you sell goods on credit, in your books, you also have an asset called trade receivables. Trade receivables is also a financial asset because it's going to give you a contractual right to receive cash. The purchaser must pay you. If he doesn't pay you, you can sue him. So trade receivables are also financial assets because they give rise to contractual right to receive cash. And I have some examples of financial assets here, like trade receivables, lease receivables, equity instrument of another entity, cash, loan receivables, and bond receivables. That's financial asset. You see, there are other types of assets, like we learned about PPE, maybe your motor vehicle, maybe your plant and machinery, even intangible assets that we learned previously. You see, all of these assets are not financial assets. Physical assets generally are not financial assets because they don't fall in these three that I've explained to you. They are not cash. They are not investment in shares. They are not investment in debt. Or if you have a motor vehicle or a plant, would that give you a contractual right to receive cash? No, it won't. Items like PPE or intangible assets, they don't give you a right to receive cash. They only give you an opportunity to generate cash. In the sense that if you don't make use of them, if you don't hustle and put them to work, you will not receive cash. But financial assets, this third part of the definition of a financial asset, contractual right to receive cash, you don't have to do anything. Just go and invest and just sit down and be looking. If you invest in debt, you will be collecting money. You will just be collecting cash. Now, the next definition here is financial liability. And what I need you to know for financial liability is that financial liability is any liability that is a contractual obligation to deliver cash. It's just like the flip of financial asset. Financial liability is an obligation to deliver cash. I will ignore these other ones. They are outside our scope here. We just concentrate on contractual obligation to deliver cash. And examples of liabilities that would give rise to obligation to deliver cash are items like trade payables. If you buy goods on credit, you have an obligation to deliver cash. You have to pay back. Also is notes payable, loans payable, bonds payable, or even lease liability. These are financial liability. And finally, is an equity instrument. Equity instrument, like we defined when we're learning conceptual framework, You said there are any contracts that evidences a residual interest in the assets of an entity after deducting all its liabilities. To put it simply to you, equity instruments is just your share capital. When you want to start a business, the money you use to start the business, you said is capital. So usually you don't have to use your own money to start a business. You can invite friends, families, or even highly placed people to come and invest in your business. It's just that you have options. If your option is that they should come and become part owner of your business, then in your books, all the money they give you is share capital. It's share capital you are going to do. So that's what we call equity. But some people don't want people to become part owner. That means in that case, you just simply issue debt. You tell them to borrow you money. And you know that in your books, then we are talking about financial liability, because it gives rise to an obligation to deliver cash. Because when people borrow you money, you have to pay back. So there's a contractual obligation to deliver cash. But when you ask them to become part owner, then that one makes life easy. Then you just put it in your books as share capital, the money you collect. And that's what we call equity. So generally, equity is just your share capital and your reserves. That is purely what equity is. Okay, so we have defined the three elements in this definition of this financial instrument. Don't forget, we are still trying to understand what a financial instrument is. We can now see that it has to be a contract that gives rise to financial assets. And financial assets, from this definition I gave you, is either cash or investments. Investments in shares. When you buy shares of another company, you have financial assets. Or when you lend people money, that gives you a contractual right to receive cash. It's also a financial asset. That's on one side. And the other entity would have either a financial liability or equity instruments. And that other entity, if what he has done is that he has issued debt instruments, meaning that he has requested that people should borrow him money, he will have an obligation to deliver cash because he has to pay back. But if what the other party has issued is share capital, is shares, then in his books, he will have equity instrument. Okay? So, but for there to be a financial instrument contract, that transaction must result in one party having financial assets and in another party having either financial liability or equity. Now, let's look at some examples of a financial instrument contract that have those two sides complete. One is credit sales. When you sell on credit, the seller would have a financial asset because in his books, he will have a trade receivables. The buyer would have a financial liability because in his books, he will have a trade payable, which is an obligation to deliver cash. Not just an obligation, a contractual obligation to deliver cash. So credit sales transaction is a financial instrument contract because the two sides are complete. It gives rise to financial assets of one entity, that is to the seller, and it gives rise to financial liability to the buyer because the seller will have a contractual right to receive cash. The buyer will have a contractual obligation to deliver cash. Another example is bank savings or bank deposits. So that transaction that you walk into the bank to deposit money is a financial instrument contract. Because depositing money into your account makes you have money in your bank, which is a financial asset. Because financial asset, don't forget, is cash. It's cash. So when you deposit money in your bank, you have cash. So financial asset of one entity. The other entity, which is the bank, would have a financial liability. In their books, the banks will call it customer deposits. And it gives them an obligation, a contractual obligation to deliver cash. Because anytime you go to the bank, you can collect your money. You can even use your app to transfer the money. So, and the bank must ensure that they do the needful as long as you have money in your bank. So, bank deposit is a financial instrument contract because it gives rise to assets to the customer or depositor and liability to the bank. The two sides are complete. One entity is having assets, another entity is having financial liability. And that is a financial instrument contract. Those two sides must be complete. Another one is a loan transaction. Loan transaction, whether you borrow money from the bank or from any other source, whether from a friend or whatever. This is also a financial instrument contract because it will give rise to financial assets to the borrower or to the person receiving the money, because that person has a right, to not to the borrower, to the lender, because that lender now has the right to receive cash because he will collect interest. He will also collect principal at maturity. So loan transaction will give rise to financial asset to the lender in form of a loan receivable, while the borrower will have a loan payable because he has to pay back both interest and principal. So it gives rise to financial liability to the borrower. So loan transaction is also a financial instrument contract because the two sides are complete. The lender is having a financial asset. The borrower is having a financial liability. Another one is a lease contract. A lease contract is also a financial instrument contract because the lessor would have a right to receive cash. In his books, he calls it lease receivable. The lessee would have an obligation to deliver cash because when you lease an asset, you have to be paying money periodically. So that's a financial liability to the lessee. The two sides are complete because one party is having a financial asset, which is a right to receive cash. Another party is having a liability, which is an obligation to deliver cash. Another one is treasury bills or bonds, like the example I gave you of buying government bonds or government treasury bills. Again, the lender or the investor or the buyer would have a financial asset because they will have a right to receive cash. And in this case, it means interest and also principal at maturity. But the borrower or the issuer, usually the government, has an obligation to deliver cash because they have to pay interest and they will have to pay the principal in cash at maturity. So they have a financial liability. Again, the two sides is complete. And that's a financial instrument contract also. And the final example is ordinary share transaction. This is also a financial instrument contract because the issuer of the shares, in his books, he would have equity. He would have share capital. I mean, the person that wants people to come and invest in his business is the issuer of the shares. He has issued out shares that come and buy my shares, be part owner of my company. So when people give him money, that's a share capital or equity. The investor, the people that are buying shares, those ones will have a financial asset. Not because they will have a right to receive cash. When you buy shares, you don't have right to receive cash because the company is not obliged to pay dividend. They can only pay dividend when they make profit. Even if they make profit, management, they can decide that we are not paying dividend. So But reason why the investor is having a financial asset is because of this definition of financial asset that said that financial asset is an equity instrument of another entity. Meaning when you buy shares in another entity, you have an equity instrument. Sorry, you have a financial asset. So ordinary share transaction is also a financial instrument contract because it gives rise to financial asset of one entity, who is the buyer or the investor, and equity instrument to the issuer, who is the owner or the person that has the idea, or the company. The company will have share capital or equity in their books. Okay, so that's by introduction to financial instruments. And as far as we are concerned, this is a very core part of financial instruments at your level. Your ability to understand whether a transaction is a financial instrument contract, and also your ability to identify which party is having a financial asset and which party is having a financial liability. So I will use this question to test your knowledge. We have 8 questions here. So I think, except if you don't have an idea, this question can go round, except if you are coming late and you don't have an idea of what we have been talking about, then you can excuse yourself. Otherwise, I want all of us to participate. I will just call you alphabetically, in alphabetical order, to attend to each of these questions. So if you look at this question, they say the following relates to Networth PLC for the year ended 31st December 2021. So they give us these transactions. And the examiner wants us to determine whether the items above are financial assets or financial liability, and also state whether financial instruments exist as at 31st December 2021. Okay, so all I just need you to tell me when I call your name is just for me to tell me whether Networth has a financial asset or financial liability, 1. And I also need you to tell me whether a financial instrument contract exists, 2. And that's it. So alphabetically, Abiodun will go first. So Abiodun, the first question is to you. And this question says that Networth owns cash of 5,000. So tell us, that cash.
The cash is financial assets.
Okay, that's correct. The cash is a financial asset. But secondly is there a financial instrument contract?
There is no financial instruments. It's not complete.
That's correct also. It's not complete because there is no other party that has a financial liability or equity. So there is no financial instrument contract here, even though Networth has a financial asset, but there's no other side. Okay, that's fantastic, Abiodun. Then the next on my list here is Kayode. So this one says that Networth owns a demand deposit of 1 million with First Bank. Networth owns a demand deposit of 1 million with First Bank. So Kayode, I need to tell us demand deposits to Networth, would that be a financial asset or financial liability?
Thank you, sir. Do I join it, but I can give it a shot.
Okay.
So the Networth, it's a financial asset.
Okay, that's
and then there is a financial instrument contract because there's another party involved here, which is a bank.
Okay, what would the bank have?
Financial liability.
That's correct. That's perfectly correct. Okay, nice one, Kayode. Lovette, you are doing the third one. And this says Networth statement of financial position includes 2.5 million shares of Google. So you need to tell me Networth, they bought shares of Google. It's like an investment in shares. So would that be a financial asset or a financial liability? And is there a financial instrument contract here?
Good afternoon. I'm not sure, but I want to try.
Please try, just try.
Okay. Networth statement of financial position includes 2.5 million. I would say it's a financial shares of Google. Let's say financial liability. But I know that financial instruments exist because there's a third party, Google. That
Okay.
gets it right.
No, you did not.
Yeah.
So, yeah, don't forget when I define financial assets, we said financial asset is an equity instrument of another entity. So when you buy shares in another entity, that's a financial asset. And what Net Worth is doing right now is that it bought shares of Google. So that is purely a financial asset to Net Worth. That's an investment in shares. Is that clear?
It
So
is, thank you.
Okay, but that's not done. I'm not done. So you are correct that there is a financial instrument contract because there is another party, Google. Now, my question to you is this. Google now, what does Google has in his books? How will he recognize that 2.5 million he collected? Is he a financial asset also, or liability or equity, or how?
If in network book it's an
No.
asset, then Google, in
Google.
Google's book it will be a liability.
No, it won't be a liability in
So it'll
Google's
be an
book.
asset as well.
It won't be an asset in Google's book. It won't be an asset. I've told you this, and I'll give an example of if you issue shares for people to come and become part owner of your company, that is a share
Yeah.
capital. It's share capital you will recognize. So Google will recognize an equity instrument, not
Okay.
liability. Okay?
Okay.
What Google will recognize is equity.
Equity instrument.
Yeah, so you have to be very careful because most students usually get this wrong. So
Okay.
most of them will get the fact that Net Worth has a financial asset. They will now say
Asset.
Google has a liability. No, Google does not have a liability. Google has an equity instrument because that's a share capital to Google. Okay?
Okay. Noted, sir. Thank you very much.
Now end of it. So is there anybody that is not clear to? Because you have to be very careful of that. Always watch out for that when it comes to shares, because that's the only scenario where the other party will have an equity, where what we have invested is shares. So when we invest in shares, we have financial assets because that's equity instrument of another entity. But that other entity, don't ever think is a liability. Is share capital to that company, not liability. Please don't ever make that mistake. Is share capital to that other entity because they are issuing out shares. Google called people to come and become shareholders. So in Google's book, what they will put there is share capital, which we call equity. Okay.
But sorry, boss. I just need to so out of curiosity,
Yeah.
I'm a shareholder now in Google, right?
Yeah. Mm-hmm.
But time and time over time, I need to exit the business, right? Won't that still be a liability to the company because they will still have to refund my share of the companies I sort of. Isn't that still a liability though?
Yeah, I get your logic, but the way it works is that this Google is not going to refund your money. As soon as you buy shares in Google, you are with them forever. If you want to exit, you just have to go and look for another shareholder to buy your shares, especially if Google is on this Nigerian stock market or a well-known stock exchange anywhere in the world. So you just call your stockbroker that I want to sell my shares. They'll just look for another person, not Google, not Google. That's how it works. Not Google giving you money. No. So it's another person that just buys over your shares. Then that person, Google might not even know that such is happening. They won't even know in most cases. Okay. Kyle, I don't know if I answered your question.
Yes, it's fine. I think maybe because a publicly listed entity, what if it is a private entity that is a limited company? Just thinking loud here because I've seen cases where you know, partners in the business, not partners really to say. Maybe we have shareholders who have up to a particular stake in the business. The three, and one is saying, "Oh, so I'm exiting the business," and then so he's saying, "Okay, so my share, though based on this analysis, if you are supposed to have three on the board of directors or so, and then it's not even board, so to say, because I think I get the logic. I get what you're saying. I'm just trying to reason something out of the fact that if it's a limited company, right, the shares still remains, right. So some other shareholder can buy over the asset, but then in if 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 the stake is transferred to whoever, it's still the fact that he's getting something back. But I get where you're coming from, and it's fine. Yeah, you clarify my questions. Thank you.
All right, Kayode, you're welcome. So, Muibat, you're going to do the next one. And
Yeah.
this is, you're doing the next one. Net worth statement of
Okay.
financial position includes inventory of 56,000.
Yeah. To the best of my knowledge, I don't think it's there's neither financial asset nor liability involved here. There's no contractual instrument contract here.
That's correct.
Because it's only involved one party. The contract did not exist between the two parties also. So
That's perfectly correct. Right, so that's correct. So, yeah, there is no financial asset, but out of curiosity again, you're correct. Inventory is not a financial asset, and there is no other party, so there is no financial instrument contract here. But
okay.
how do you then classify this? What type of asset is this? I mean,
Inventory.
exactly inventory. Inventory is inventory, right? According to IES, it's just inventory. So you're correct, me, but okay, nice one. So we have gone around. So we'll start over again. Now, Abiodun, you are doing the next one. This one says that net worth sold goods amounting to 55,000 to Lai Limited on credits. Net worth sold goods amounting to 55,000 to Lai Limited on credits. So
there is a contractual agreement here. So financial instrument exists. Net worth sold goods to Lime Limited on credits. It is a financial asset. So Lai has the right to receive cash. Net worth has right to receive cash from Lai. So it's a financial asset to net worth. Why is that financial liability to Lai? Because he has the right to deliver cash to net worth.
that's fantastic. Lai has an obligation to deliver cash to net worth. That is correct. So net worth has a financial asset in form of a trade receivables. Lai has a financial liability in form of a trade payables. So the two sides are complete. We have a financial instrument contract. Perfectly correct. Kayode, back to you. So this says that on December 2021, net worth received an advance payment of 250,000 from one of its customers, Muri Limited, to deliver goods in January 2022. So what do we have here?
So thinking through this, right? I think there is a financial contract existing between two parties in the first place, and then in settlement of that contract, what was received from net worth is a financial asset, and then the customer paying this is a liability in settlement of the asset, in settlement of the liability.
Okay, so all right, that's a good attempt. But looking at it closely, what has happened here is that net worth has received money of 250,000 from Lai to deliver goods. to
Oh,
deliver.
I see. Advance.
Yes. It's just like you
Yeah,
want to
received
buy
in
a car.
advance. Yeah. Yes. So to net worth is a liability. Is an advance payment.
Exactly. It's a
So
liability. That's what. But the question
yes.
is, are you saying it's a financial liability?
Come again, please.
Yeah, I agree with you that when you receive money in advance for what you have not delivered is a liability to you. So net worth has a
Yes.
liability. But the question is that, is it a financial liability to net worth?
It's an asset to them.
To net worth?
Receive payments in advance. This. Uh since payment is not due, right? I think it's a liability to net worth, right?
It is
When they
liability,
get
correct. It
yes.
is liability. But is it a financial liability? Because not all liabilities are financial liability. So is this particular liability a financial liability?
No, I don't think so.
And that is correct. It is not a financial liability. But I mean, what was your logic? Why did you decide that it is not a financial liability?
It's more like an advance payment. So uh um they say prepaid the item. So that's my
Okay.
logic.
So the reason is this. The reason is this. The definition I give you for financial liability is that it is a contractual obligation to deliver cash, quote and unquote, cash. This one, what net worth has an obligation to deliver is goods. So this is not a financial liability. When what the obligation you have is to deliver anything else other than cash, that is not a financial liability. It's just like you give me money that I should buy car for you because me, that is what I do. I sell car. You now gave me money and I told you that this your car will be ready in 6 months. In my books, I cannot recognize that kind of money as revenue. I will debit bank because I've collected money. I can't credit revenue because I've not sold. I've not delivered. What I would rather credit is a deferred income, which is a liability. And that's the situation here. So that kind of liability, because that deferred income, anytime I'm saying it, I will know that I have an obligation to deliver car. That is not a financial liability. A financial liability is a contractual obligation to deliver cash. Here now, the scenario is that what net worth has to deliver is goods. Is goods, not cash. So net worth does not have a financial liability, and that means the two sides will not be complete because the other guy does not have a financial asset because the guy has simply prepaid, and prepayments, what you have right to receive is goods, and for it to be a financial asset, you must have right to receive cash, just like financial liability. So for this question, the answer is that there is no financial liability, there is no financial asset, and there is no financial instrument contract. And that's the solution to this question. Okay.
Thank you for that. I
Yeah.
didn't get that definition initially. Thank you.
Okay. Yeah. Lovett, you go next. Net worth statement of financial position includes current tax liability of 5,000 as well as deferred tax liability of 6,500.
Okay, obviously, net worth doesn't have, there's no financial instrument here. It's not an asset. It's just a liability. I think it's just a current tax liability
Okay.
and the deferred tax liability.
Okay.
I know it's not an asset, and I don't think it's a liability.
But correct, you are correct because you are correct not because of. Are you saying current tax liability is not a liability? It is a
If I
liability.
understand, it is a liability.
But is it a financial liability?
It's not a financial liability because cash is not involved.
But when you have current tax, you have an obligation to pay cash. You will pay cash eventually now.
Okay.
Yes, no. At least for current tax.
Well, the fact they're not paying now, so it's just a deferred tax liability.
No, that's what make it a
Deferred tax, they're not paying tax now. It's been deferred.
Let's leave deferred tax alone. Let's deal with current tax, right?
Current tax.
Yeah.
Okay.
So is it a financial liability or not?
It's a financial liability.
It is not.
Hey, God. I, it's,
Not.
but you just said that you pay tax. Like you're going to pay
Yes.
cash. You're paying.
Yes, you would pay
Initially,
cash.
I thought it's not a financial liability because, well, I think it's just a tax liability, but it's not a financial liability.
But why? If you are saying it's not, tell me why.
What if you want? I feel, well, if you're paying, it doesn't have to be like cash. You're going to pay money, but it might not be cash.
It's cash. It's cash you pay. It's
Please,
cash
which
you
one is
pay.
it?
Is a financial liability. A current tax liability is not a financial liability. And the reason is that it is not contractual. You don't have a
Okay.
contract with the government. A financial liability is a contractual obligation to deliver cash, right?
Okay.
Yes, you know that tax, you deliver cash, quite all right. But
Okay.
the reason why this current tax liability here is not a financial liability is because it is not contractual. You don't have a contract with the government. Paying tax is just like a responsibility you have as a citizen. It's just like your civil obligation, civil responsibility, not because there's a contract. Deferred tax, that one does not even involve delivering cash. It's not something you pay anyways. You never pay it. It's just an accounting measure to match tax and account. So deferred tax is far from being a financial liability. So that is it. But you gave it a good trial. Now, we are back to Muibat. The last question here is that net worth purchased a Bitcoin of 5.5 million. Net worth purchased a Bitcoin of 5.5 million.
Yeah, I think here we have two parties, the net worth and the Bitcoin trader, which to me, I know I'm not into the trade. So, but what I know the Bitcoin to be is a trade that's is just a payment network, with kind of new payments, new money where they make money like that. So for me, I would say, yes, it is there is a financial instrument contract between the net worth and the Bitcoin trader. And there, I would say that the net worth has a contractual right to receive cash because Bitcoin has invested in, the net worth has invested in it. And then the Bitcoin trader has the contractual obligation to deliver cash. I don't know if you remember right with that. So
That's a good trial. That's a good trial, but it's not right.
okay.
Yeah. Bitcoin is not a financial asset because it doesn't give you contractual right to receive cash. In fact, Bitcoin is just an example of cryptocurrency. There are other ones. There is Ethereum, there is Dogecoin. There are a lot of them out there. So they are just trying to replace money. They are just trying to centralize the monetary system in such a way that no single person has control over the monetary system. So when you buy Bitcoin, for example, now, you don't have right to receive cash. In fact, you can even lose that money because the value goes up and down. You could get there and you want to sell your Bitcoin and you find out that the value has gone really down, and you could be lucky the value could go up. So it doesn't give you right to receive cash. If you buy Bitcoin, they credit your wallet with a Bitcoin.
Okay.
And if the value has gone down, you cannot sue the guy when you want to sell. You might even want to sell and not see the person that will buy. So it doesn't give right to receive cash.
Okay.
So, and Bitcoin is not cash. Bitcoin is
Okay.
not cash because according to IES 7, when you say cash, cash is a medium of exchange that is generally acceptable.
Yeah.
Not
As a
generally
medium of
acceptable,
exchange. Yeah.
right? It's not generally acceptable. And the
Okay.
risk of changes in value is very high for Bitcoin. The value changes like so much. So when networks purchase the Bitcoin, it's an asset, quite all right, but it is not a financial asset. It doesn't meet those three things.
Okay.
But so there is no financial asset, there is no financial instrument contract here. But the big question is this: how do you classify Bitcoin in your books? What class of assets will it belong? Let's look at it together. Can it be PPE? Can Bitcoin be PPE?
Bitcoin, PP?
No.
I mean,
Yeah.
no, it cannot.
It
I know
cannot.
because PPE is a tangible item.
Tangible assets.
Yeah, and Bitcoin is not tangible. It's not something you can see or touch. It doesn't have physical substance, right? So PPE is out. Can Bitcoin be an intangible asset? Yes. Yes,
It's
it
an
can.
asset, but okay.
It is. It can be an intangible asset because I taught you intangible asset 2 weeks ago, and I told you that intangible asset is an identifiable, non-monetary asset without physical substance. Identifiable in the sense that it's separable. You can sell it, or it's arising from legal. So you can sell your Bitcoin. And non-monetary means that the value you get back varies. That's what makes it non-monetary. And it's without physical substance. You can't see it. It's just a wallet. You just look at it on your phone. Oh, I have so amount of Bitcoin. So Bitcoin, yes, if you work with a company that buys Bitcoin, you can classify it as an intangible asset. Not only that, can Bitcoin be an inventory? Yes, it can also be an inventory. If you buy Bitcoin with the aim of reselling, like you bought a lot and you want to be selling it to people, it's an inventory in your books. It is an inventory. So Bitcoin or cryptocurrencies generally can either be an intangible asset or an inventory, either of them. And that's how this will be treated, not a financial asset.
Not a financial asset. All right. Thank you.
Okay, so you see, this we just did is extremely important. They will test your knowledge around this in the exams. Now, let's move to the next part of it. And all this we learned now is from IAS 32. It's from IAS 32. Now, let's go to IFRS 9. IFRS 9. And IFRS 9 deals with recognition and derecognition of financial instruments. So when we say recognition, you know that what that means is recording or incorporating or including into the financial statements. And according to IFRS 9, right, financial instruments, whether financial asset or financial liability or even equity, can only be recognized when the company becomes a party to the contractual provision of the instrument. When an entity becomes a party to the contract, then you can recognize that financial instrument in your books. whether you have an asset or a liability, when you become a party to the contract, and an entity becomes a party to the contract, either at the date of agreement or the commitment date. At the date of agreement, in the sense the date the contract was signed. At the date of commitment, maybe the date you maybe invested, or if you are the one that is collecting money, the date you collected money, that is the date of commitment. So majorly, what I need you to remember for recognition is that as soon as an entity becomes a party to the contract, then you can recognize whether it is a financial asset you have, go ahead and recognize it. Whether it's a financial liability you have, go ahead and recognize it. Go ahead and recognize it. But you know that for financial assets now, how would you recognize a financial asset? Because for you to have a financial asset, you would probably be the investor. You would probably be the one parting away with money. So you would obviously be crediting bank, and you would have to debit a financial asset, right? If you are the one having a financial liability, you would obviously be crediting the financial liability, because in that case, you'll be receiving money. It's either you are borrowing money or you are looking for shareholders. So you most likely debit bank and credit the financial liability. If it's shares, you probably would credit share capital if you now have shareholders, right? So that is recognition. Now, the next one is the recognition of financial assets. Now, we want to, for the recognition of financial assets is different from the recognition of financial liability. So we have to take them separately. So for financial assets, they are derecognized. The recognition is the removal of previously recognized instrument from an entity's statement of financial position. So when you derecognize, it means that you are removing what you have recognized before in your books. That's derecognition. So you can only derecognize or remove financial assets when the contractual right to the cash flow from the financial asset has expired. Don't forget, financial asset is a contractual right to receive cash. When that your right to receive cash has expired, and it will expire either when they have finished paying you your money or when the period has elapsed. That means you can't collect money again. Just remove it from your books already. So when your contractual right to receive cash has expired, do you recognize it? Or the entity transfers substantially all the risk and reward of ownership of the financial asset to another entity. It transfers substantially all the risk and reward. And what this is speaking to is, for example, now, if you had invested in shares, you bought shares, it's a financial asset. When you sell that shares to another party, you have transferred the risk and reward attributable to ownership. And that's why I said that what this means is an unconditional sale of the financial asset. When you sell, or maybe a sale, and you have an option to buy back at fair value, this B part is just beyond your scope here at skills level. But majorly what I need you to understand for this second part is when you sell the financial assets, whether conditional or unconditional, you derecognize it from your books, right? So this is the recognition criteria for a financial asset. Number one is where your contractual right to receive cash has expired. Number two is that when you have transferred substantially all the risk and reward of ownership of that financial asset, usually is when there is an unconditional sale of that asset. The next one is the recognition of financial liabilities. And the financial liability is derecognized when it is extinguished. Extinguished. You see, ordinarily, you know that financial liability is a contractual obligation to deliver cash. So one would expect that as soon as you have delivered the cash, you should recognize that financial liability. And believe me, that is what this extinguished, that's what it means, right? And that's why they went ahead to say that when the obligation specified in the contract is discharged, discharge means you have settled, it's cancelled, right? So there are instances where you might not have settled, but they just cancel it. They just forgive you the liability that don't pay again. That's extinguished also. Or maybe the time elapsed, it expired. So you won't have to settle anymore. So that's why they didn't use settle, because other events could happen that could make you derecognize. That's why they use extinguished. Extinguished is either it is discharged, that is settled, cancelled, or expired. Okay? And that is all that I need you to know at your level here. So there are some other issues around financial liabilities, again, that you should not bother yourself. Usually when there is an exchange of financial liability, or when there is a modification that is substantial, and all of that details, you guys are free from that for now. When you get to corporate reporting, you battle with that. But just understand that financial liability is derecognized when it is extinguished. Then you can easily take your mark and move on. Now, we are done with recognition and derecognition. Now, what we are going to now is measurement. Measurement of financial instruments. So measurement is just, okay, how much? How do you determine the value? So we'll pick them one by one. We'll look at measurement of financial assets. We'll look at measurement of financial liabilities. And also, we'll look at measurement of equity. So I will start with equity, right? Because there is no stories around equity. The standard didn't really talk about measurement of equity, especially if it is share capital. Of course, equity instrument is share capital. So how do you measure your share capital? Usually, according to CAMA 2020, you measure your share capital at nominal value. Nominal value. And this nominal value, you most likely get it from your CAC documents. When you register a company, they will ask you what's the nominal value, what's the number of shares you want to register with. That's what will be in your books as your share capital. If you want to have any amount above that, you have to go and update your CAC documents. So in some other countries, it could be different, but in Nigeria, that is the way it works. That's how it works. So your share capital is always measured at the nominal value. If you eventually issue the shares above the nominal value, any excess doesn't go to share capital account, it goes to your share premium. So what goes into your equity is just your share capital and your reserves, of course, but the share capital would only have the nominal value of those shares. Any amount above those nominal value will go to share premium. And that's the entire story for share capital or equity. I won't really come to that anymore. Okay, you'll find things like this in published, so they will believe that you understand that what goes to share capital account is always the nominal value. Then the next one is financial assets. I'll do financial assets. So I'll start with measurement of financial assets. Now, in dealing with financial assets, you need to remember that financial assets, I mentioned 3 things on financial assets. The first I mentioned is that financial asset is cash. And how do you measure cash? Your cash is your cash. There is no other way of measuring it. It's just your cash. If you have 10,000 naira at hand, in your books is 10,000. If you have 50,000 in your bank, in your books is 50,000. Cash is cash. So no story around that. This next one is that we said financial asset is an equity instrument of another entity, which I said that means you bought shares in another company, and that's where I'll start from. And that's majorly investment in equity instruments. So how do you measure that when you buy shares in a company? Now, I need to call our attention to something because I know that Mr. Kazim has already started teaching you group account. Everything he is going to teach you in group account is all about accounting for investment in equity. Just that what he is dealing with in that area is investment in equity whereby your holding is so much that you have significant influence or control or joint control. That is, your holding in that investment has given you so much holding that, talking about percentage, is 20% and above. The investment in equity instrument I want to talk about here is where your holding is less than 20% or when you don't have significant influence, right? You would remember the story of Otedola when he bought into First Bank. Right now, he's the chairman. He bought so much holding that he had control of the bank. I think he had like 7%, right? So now he's the chairman, right? So because he had control. The one we are talking about here is just a simple investment where your holding doesn't give you significant influence nor control. It's just, that's what we call financial assets. So the one Mr. Kazim is teaching you would result in an associate investment or a subsidiary investment. But this is just a financial asset. So when you buy shares, how do you account for those shares? In your books, it's quite straightforward. When you buy shares, those shares will be recognized at the transaction price. That is, the amount that was invested or the amount that was paid for the instrument. So if you bought 5,000 Naira shares and they sold it to you at 2 Naira per share, in your books, you simply recognize that at 10,000 Naira. 10,000 Naira. And that is it. And that is it, 10,000 Naira. So investment in shares is initially recognized at the transaction price. And the date you bought the shares, right? The date you bought those shares, the standard requires that you have to classify those shares. You have to determine the classification. And the way you do that is that we need to be able to understand your intention for buying those shares. And the intention an entity will have for buying shares is either they want to hold it for the long term, is either they want to hold it for the short term or for trading, or they want to hold it for the long term. That's the reason why people will buy shares. Is either you just want to buy it that, okay, and maybe you need money by the end of the year and you just don't want to keep the money in the bank, that when the value of the shares goes up, you just sell. That's buying it for the short term. And some wants to buy it for the long term, that they are not going to sell. They want to become part owner and even become a major stakeholder in that company. Some people even buy shares for their children. That, okay, they will just buy it and keep it for decades, right? That's for the long term. You see, when you buy shares for the short term, IFRS 9 says that you classify those shares at fair value through profit or loss, which I shorten as FVTL. But if you are buying it if you are buying it for the long term, you classify that kind of investment at fair value through other comprehensive income, which I shorten as this. So it's either you are classifying it, so there are two classifications here now. Is either you are classifying it at fair value through profit or loss, or you are classifying it at fair value through other comprehensive income, depending on your intention. So, and why is this classification even necessary? And you see, this classification is done on the date you are buying it. So if your company, you work with a company that invests in shares, you must know why they are buying it. Is it for the short term or the long term? Because you would have to classify it into these two. And the reason is that it usually would help users to make decisions. Now, you know now that when you see a financial asset and they classify it at fair value through P&L, from what I've taught you now, you know that means that the entity is just holding it for the short term. That means they will sell it very soon. So when you're making your decision around their investments, you know that what they have done is majorly short-term investments. But if you see that they classify it at fair value through OCI, then you would have an understanding that these guys are actually holding this investment for the long term. So, I mean, it can influence your decision making around that company. So looking at an example, the company called Wasu PLC purchased 5,000 units of ordinary shares of BPLC at Sunera on 1st of January 2024. And we're told that Wasu intends to sell the ordinary shares at the end of the year. When I asked, how will this investment be initially measured and classified? Again, initially, Wasu would measure it at 10,000 naira, which is the transaction price. That is 5,000 multiplied by 2 naira. And since we're told that Wasu intends to sell it before the end of the year, that means he's holding it for the short term or for trading. So Wasu will classify the investment at fair value through profit or loss. And so in your books now, you simply debit, we call it financial asset at fair value through PL. That's how that account name will be called. Financial asset at fair value through P&L. So when I see at fair value through P&L, I will simply know that, okay, that means this financial asset is held for the short term. That means these shares this company has bought is for the short term. And of course, they will credit bank because they are investing, they are passing away with money. Okay. Then going ahead, then I talked about if there are transaction costs, like stockbrokers fees. Because usually when you want to buy shares, you would use a stockbroker and you have to pay that stockbroker. So how do you treat that kind of money you pay to the stockbroker, which you call transaction cost? So the standard said the treatment of these brokers fees depends on how you have classified the financial asset. If you classify the financial asset at fair value through POL, the transaction cost will be expensed. But it will be capitalized and added to the initial costs or transaction cost or transaction price if it is classified at fair value to OCI. So if you classify the financial asset at fair value to P&L, transaction costs or brokers fees will be expensed. But if you classify it at fair value to OCI, such would be capitalized. Transaction costs would be capitalized. Okay, so again, we are still looking at investment in shares or equity. We have looked at initial measurement and transaction price. And at the date of initial measurement, you classify it either at fair value to POL or at fair value to OCI, depending on your intention of holding the asset. If it is for the short term, you classify it at fair value to POL. If it is for the long term, you classify it at fair value to OCI. And if you incur any additional costs like transaction costs, such costs to be expensed. If you are classifying it at fair value to POL, it would be capitalized. If you are classifying it at fair value to OCI. Now, that's at the beginning of the year. What happens at the end of the year? At the end of the year also, you would measure it the same way you have classified it. That is, at fair value to POL and at fair value to OCI. And the way it works is that if you classify the financial assets at fair value to POL, that means at the end of the year, you are going to measure it at fair value to POL. If you classify it at fair value to OCI, at the end of the year, that means you are going to measure it at fair value to OCI. So the subsequent measurement must be consistent with the classification. What is then the difference between these measurement bases? Between when we say fair value to POL and fair value to OCI, what's the difference? See, the difference is just where gain or losses is recorded. when I say gain or losses, this example I gave you was an example where Wasiu bought shares for 2 naira. At the end of the year, you won't expect shares to remain 2 naira. The value will either go up or come down. If the value becomes 3 naira, that means you have gained like almost 5,000 naira, because the value of your shares become 15,000 at the end of the year. So if you are measuring it at fair value through POL, it means that that changes in value or that gain is going to be recognized in POL. That is what fair value through POL means. That, okay, measure this thing at fair value, but any changes in value, take it to POL. But if it is fair value through OCI, again, it means measure it at fair value, but any changes in value, take it to OCI. Take it to OCI. So that is it about investment in equity. That is all around investment in equity. Any question before I move to the last part of financial assets, which is investment in debt? Questions. Okay. So let's go to investment in debt instruments. Now, this is also under financial assets, but this is the third one that has to do with contractual right to receive cash. And this is usually when you lend people money or you borrow somebody money. So remember that investment in debt, we're talking about maybe you bought a bond or you bought a loan or you bought government treasury bills, and all of these would carry interest, and there is a capital element of repayment, right, at the end of the period, at the end of at maturity period. And usually when you have a debt investment, to measure it is not really any pressure, because it's just at transaction price. It's just really the amount at which you'd invested. That is just it. But just like investment in equity too, you need to classify that investment. You need to classify it. And the standard said you can either classify it at amortized costs, or at fair value through OCI, or at fair value through POL. Fair value through OCI, fair value through POL. Okay, so how do you determine the classification into these three? And that takes us to the basis of classification. Okay, the basis of classification. So the basis depends on the entity's business model and the contractual cash flow characteristics of that financial asset. The entity business model and the contractual cash flow characteristics of that financial assets. So if I want to break this down to you now, when we say business model, what business model means, okay? What business model means is that, what business model would mean is that this, it means is that whether the entity, what business model first of all means is how you would make money from the financial assets. Is how you would make money from the financial asset. So for debt, is two ways. Is either you are collecting interest and principal repayments, or principal repayments. That's majorly one of it. Or collect interests and principal repayments, as well as sell the financial asset. So it is either of these two. It is either of these two. It is either of these two. So it's either your business model is just to collect interest and principal, or to collect interest and principal, as well as sell the financial assets. Okay, so collecting interest and principal is something that's constant for debt. They will pay you interest and you collect your money back, right? So that's why it's either just that alone, or in addition to collecting interest and principal, you can also sell that financial asset if you wish to. In Nigeria now, if you want to sell your debt, just go to FMDQ. You see people that will buy your debts. That's if you have bought it from FMDQ anyways. So, okay, don't, yeah. The second one is another basis of determining how you classify into these three is the contractual cash flow characteristics. And what this simply means, right, is that there is a contract. It means that there is a contract, that specifies collection of interest and principal. There's a contract that specifies collection of interest and principal. So, right. So that's the contractual cash flow characteristics. Again, no, this one is something that would always be there. Most debt instruments, there will always be a contract. But we are saying the contract must specify that, okay, what you will get is interest and principal. That's what this second one is talking about. While for this one, the business model is either you are just collecting interest and principal, or you're collecting interest and principal, as well as you can also sell the financial asset if you wish to. So now let's look at, before you can classify at amortized costs, what must it meet? Then at fair value through P&L, what's the condition? And at fair value through P&L, these are fair value through OC and all of that. So because there are three of them here. Now, before I start that, let me attend to what Abiodun was asking. So Abiodun is saying this a question in the exam, calculation of theory. Majorly, it has been theory, majorly. So last two diets calculation, and you always find questions on this part in published, which you are still going to look at majorly in your exam. You'll find some question in public. I'm still going to look at all of that. Let's take it step by step. Okay, so still on debt investment. Now, I want to start at when can you classify a debt investment as amortized costs? So if it meets this business model and contractual cash flow. Now, you can classify a debt investment at amortized costs if the business model of the company is that they will collect interest and also receive principal at maturity, which is this first one. That's the business model. And contractual cash flow, it means that there is a contract that specifies collection of interest and principal. That is what it means. So the last three diets were around 2022, when they ask you that you should explain classification of financial asset. So when you're going to explain amortized costs, it's just for you to tell the examiner that you can classify the financial asset at amortized cost, where the business model is that the entity is holding the assets in order to collect interest and principal at maturity. And there is a contract, because you have to talk on this business model test and this contractual cash flow test. That is, there is a contract that says that, okay, what this guy will collect is interest and principal. Because there might be a contract that will say, okay, what you're going to collect is just principal, no interest too. That means you cannot classify it as amortized cost. There has to be a contract that will specify that you are going to collect interest and principal. Okay? So, and that is the condition for classifying at amortized costs. So we'll look at some questions now. But before I look at those questions, let me just complete the others. At fair value through OCI, before you can classify a financial asset at fair value through OCI, the business model test is that second one, where that you are holding the financial asset to collect interest and principal, and also to sell. So that's the difference between fair value through OCI and amortized cost. Amortized cost is that the business model is just to collect interest and principal. But for fair value through OCI, the business model is to collect interest and principal and to sell, meaning you can sell the financial asset. And this is usually, maybe you want to maintain a particular interest yield. Maybe the guy that you lend the money to initially was giving you 5%. Now you see somebody that is ready to give you 8%, then you have to most likely go for that person. And the contractual cash flow is that there is a contract that specifies that, okay, you collect interest and principal. That's what this is all about. There is a contract that says that, okay, you collect interest and principal. Now, the third one, which is fair value to POL. You see, this third one is a default category in the sense that financial assets for debt instruments, for debt investments, should be measured at fair value through POL, unless where they are measured at amortized cost or at fair value through OCI. So this P&L doesn't have a particular basis, just that ordinarily, if you don't want to stress yourself about business model test or contractual cash flow test, the default category for debt investments is fair value through POL. So, but if you now decide that you want to consider business model and contractual cash flow, then that means you then use either the amortized cost or the fair value through OCI. Otherwise, you just measure it at fair value through POL. Okay, now let me pick them one by one and see how we calculate the figures for each of them. Let me start with amortized costs. So let me give a very simple example. We'll look at three scenarios. So the scenario one now. So let's say you have a 10 million naira loan, 10 million naira 5% loan with 10 million repayable at the end of the third year. Okay, so this is very straightforward. And this is mostly what you might find in your exam. They will just give you, okay, you invested 10 million and you're supposed to get 5% per annum. And the repayment period is 3 years. You get your 10 million back. So what this simply means is that in your books, when you invested that 10 million, you simply debit financial asset and credit bank with 10 million. And at the end of the year, every year, you would simply recognize interest of 500,000. That is 5% on the principal amount, which is 500,000. And that is it. At maturity, when you're expected to collect back your money, because they're supposed to repay you back your money, because money is going to come into your debit bank, and you credit the financial asset to recognize it from your books. So this one is very straightforward. So here now, you will see that over the 3 years now, for this simple example I gave you, how much profit have you made from these investments? Who can tell me? Kayode, how much profit have you made from this investment now? From this simple example I gave you.
For the 3 years, 1.5.
Fantastic. Cheers to that. Okay, good. You have made 1.5 million profit in form of your interest every year, because you are still going to collect back your 10,000 naira at maturity or 10 million. Now let's look at the ones where we can have a little bit of issue, which is the one you might likely find in your exam. They also ask this first scenario too, but this second one is whereby you are going to be repaid at a premium. or maybe there is an initial transaction cost that was incurred. Just let me show you what I'm talking about. So you invested in a 10 million naira loan on 1st January 2001, and you will get 5% every year, but then you are getting back 11 million at the end of the 3rd year. So my question to you is this again, and Kayode again, how much is this guy making over the 3 years in this scenario now?
I suppose it's going to make 2.5.
That's correct. That's correct. Yeah. He's making 2.5 million. So this guy, since he's going to get 5% every year of 10 million, that's 500,000 per annum. But then he's getting back 11 million. That's an extra 1 million again at maturity, making 2.5. So again, so the challenge is this, right? Is about the income. How is he going to recognize the income? You know, from this first scenario now, this 500,000 is recognizing it year by year. Year 1, 500, year 2, 500, year 3, 500. The same way is going to recognize this 5% here. But again, another question, this will go to Muibat now. This 1 million extra is making at maturity. At what point do you think you recognize that income? Which I'll call premium. When will you recognize it?
Sorry, can you repeat that? Just coming.
So this extra income of 1 million is making in this second scenario now, this premium, because it's getting back 11 million, extra 1 million, that get back at maturity. That's it, and that's an additional income of 1 million there. When will you recognize that 1 million? When should you recognize that 1 million as income? Okay. Is there any other person that can help?
At the maturity date.
At the maturity date. Okay, that's quite logical, right? Because that's when he will collect back the money. But accrual concept is going to frown at that.
Exactly. Yeah.
Accrual concept will tell you that no, this loan is over 3 years now. Yes, this money is actually coming in the 3rd year, but this loan is over 3 years. So accrual concept requires that you recognize that 1 million also over 3 years, right? So which is what I'm trying to explain here, that you are earning 2 income now. You are earning the 5% each year, and you're also earning 1 million over the 3 years. So you need to recognize it over the 3 years. So the question is, in what proportion? In what proportion? So the proportion, they use an effective interest rate method. So the examiner would have found a way to allocate it over 3 years, and they will convert it to rates. In this case now, they will give you an effective interest rate. So whenever you see in an exam where they give you the normal, we call this coupon rate or nominal rate, they now give you an effective interest rate. Just know that it means that the guy has made extra income. In addition to that nominal, he's also making additional income that they also want you to recognize. So in this case, it has to be 8.08%. Don't bother about how they calculated it, because they will just give you. So this 8.08% includes this 5% and a portion of this 1 million. So by the time you recognize this 8.08%, you will have captured that 500,000, that 5%, and also a portion of that 1 million for each year. So that means it will now help you spread that 1 million over the 3 years. So it is this one that will now go to your P&L, this 8.08%. And the way it works is this, right? When you have effective interest rate, it's just easier for you to use a table like this. So in year 1 now, when you invested the money, so the balance at the beginning was 10 million. Then the effective interest rates at 8.08%, you just apply this 8.08% on 10,000, which is 808. So it is this 808 that will go to your P&L in year 1. because it already includes the 5%. It will have already included the 5%. But the thing is that the actual amount you received as interest is actually 500,000, which is 5% of this 10 million. That's what you actually receive. Okay. But what you earned in year one is that 500 plus a portion of that premium. But what you received is just the 500. So the balance at the end of the year is this. If you do this minus this, that's 308, and you add your initial investment, that will give you 10,308. This 10,308, in year two, you carry it forward. It becomes a brought forward in year two. You apply this 8.08% again on this 10,308. Then that gives you 833. So in year two, what goes to your POL is this 833. But what you will receive is 500. This 5% is fixed every year. It's 5% on the principal amount. It doesn't change. So 5% on 833, that's 500. Then the balance, which is 10,308, if you had 833, you subtract 500, that gives you 10,641. And in year three, you bring this forward, 10,641. You apply 8.08% on this opening balance. It gives you 859. Then this 500 is constant. It's always 5% on the principal or the amount invested. It's always on the principal amount majorly. By the time you do your maths, you get 11,000. You will see that it has to give you that 11,000, the maturity amount that you are expected to get back. It will give you, because this effective interest rate has helped us to spread it. And if you carefully add these three together, this 828 plus 833 plus 85, can you add it and let me know what you got? Do any of you have calculator there and add it? Let's see what you will get.
25.
Exactly, 25, which is what Kayode said earlier on, that's the total income we are making. So this amount that is spread over 3 years comprises the 500 and a portion of that 1 million. Okay, just help us to spread it over 3 years. So this is most likely what you will find in your exam. I would really appreciate you get used to this, where they will give you an effective interest rate. So that shows that in addition to that nominal interest, the guy is also making an additional income, usually in the form of a premium. So which has to be recognized over the relevant periods, in this case over 3 years. So effective interest rate does the magic for us, does the magic. Okay, so while this is going to P&L, you see this 10,308 is what we call amortized cost. And this is what will go to my non-current assets. And why it is a non-current asset is because this amount is receivable after more than 1 year. Because this is year one, we are still going to year three. So this will come in as a financial asset at amortized cost. In year two, we are going to recognize 833 also. But in year two, this will now come in as a current asset, financial asset at amortized cost, but it will now become current because now it's due to be received within 1 year, which is next year. But in year three, this 859 will still go to my PLL, and I'll be collecting back my 11,000. This is when I will now actually collect back my premium. Then I'll pocket it and use it to do something meaningful for myself. But Accrual has helped us to spread it, the premium and the nominal interest, over 3 years. These are what goes to PIL. Again, you have to master this. I mean, this is the time you ask questions if you have any. Ask questions if you have any, before I move to the final part.
Okay, so thank you very much, sir, for that. Looking at year one, in my books, as you mentioned that the 10.3 will be recognized in as under non-current asset. I mean, is it not current?
Yes, in year one, non-current.
Oh, okay, all right, thanks.
Yeah. Questions. Okay, so in the absence of all these explanations, it's just all the explanation have been given to you. So a little notes about this what do they call it? Amortized costs, fair value to POL or fair value to OCI. Now, what I need to tell you is this. You see, usually in the exam is amortized cost they will ask you, okay, as the measurement basis, because the way you have classified these debt investments, either at amortized cost or at fair value to OCI or at fair value to POL, is the same way you measure it, is those three. So mostly you should expect something like this in the exam. But magically, let's say the examiner just wants to be funny and they say that, okay, they use fair value to OCI, for example, now. You see, what the examiner would have to do, the situation they have put themselves into is that they now have to give you a fair value because you are still going to do this. Because as far as debt is concerned, you must always calculate interest. You must always. So you always do this. But the examiner, if they say, okay, use fair value to OCI for the debt investment, that means they have to give you a fair value. So if, for example, now in this year one, now they gave us 10,600 as a fair value. Is that 10,006 that will be in your books? But since it is fair value to OCI, the difference between that 10,600 and this 10,300, that difference, just go and recognize it in OCI. And that's it. That's just the difference. If it is fair value to P&L, that difference, put it in P&L. That is just it. Okay? But I don't see ever them asking you that. No. They won't. Expect just amortized cost, then you just calculate it and move on. And that is it for financial assets. That is it for debt investment and equity investment. Finally is financial liabilities. Finally is financial liabilities, right? So for financial liabilities, usually they are classified at amortized cost. Usually, but when you when you borrow somebody money, when you have financial liabilities, you are the one that is borrowing money, you are the one that is collecting money. So when you collect money from people, you borrow money from people, in your books initially they are recognized at they call it net proceeds, or sometimes they call it transaction price. And this net proceed is speaking to the cash you received minus issue costs. This issue cost was what I called transaction cost initially. And what I'm looking at is this. Let's say an entity raised 10 million and they have to involve a stockbroker, which they pay 200,000. So initially in his books now, he's going to debit 9.8 and credit liability with 9.8. So he's not going to recognize 10 million, but rather he's going to recognize 9.8. It says that in the sense that when you collected 10 million, you will have majorly paid the broker from that 10 million you borrowed. So that's why what you're recognizing in your books is 9.8 million. Now, that takes me to my final scenario. Which is this. And this is a situation whereby an entity borrowed 10 million, is supposed to pay 5%. he incurred 200,000 issue cost. And also, he's going to repay at a premium of 1 million. The examiner gave us an effective interest rate of 8.85%. For them to give you an effective interest rate of 8.85%, that means this 8.85% is that the cost that this guy is exposed to is beyond this 5% per annum. He's also going to incur 200,000, and he's also going to pay back at the premium of 1 million. So Kayode, how much is now this guy's cost over the 3 years now? How much is his cost over the 3 years?
So if we are looking at just ordinarily without or considering the interest 8.8 point
No. Leave that 8.85 now. So it's just like the other one, now you're able to get that 2.5 easily because I didn't talk about this one. So it's just 5% per annum on 10 million for 3 years, because it's 3 years now. It's maturing in the 3rd year. That's 1.5 million. He's going to pay additional premium of 1 million. That's 2.5 million. And is incurring additional issue cost of 200,000. That's 2.7 million. So that's 2.7 million over the period. Why this one is coming in is that it's just like the previous explanation I gave you, that yes, this 5% to be recognized each year, year 1, 500, year 2, 500, year 3, 500. But you have to ensure that you recognize this 1 million to over the 3 years. Don't recognize it at maturity. And also this 200,000 also, you have to recognize it over the 3 years. So this 8.85% is one that will help us to allocate or comply with accrual concepts that will help us spread it over the 3 years. Okay, but looking at it at a glance, you know that this guy, for him to borrow this 10 million, is paying a cost of 2.7 million. The 5% per annum, the 200,000 issue costs, and the 1 million additional on the principal, that's 2.7. So the way it works is that you will still use amortization schedule similar to what we looked at for the cost. So at the beginning, he's going to recognize it at net proceeds, which is the 10 million or the 10,000 minus the 200,000. The 10 million minus 200,000. You recognize it at net proceeds, 9.8 million. Then you recognize the effective interest. This is what will come into P&L as a cost, as a finance cost, which is 8.85% on this 9.8 million. And that gives me 867. But what he will pay as interest is going to be at 5%, which is 5% on 10,000, not on 982. The amount he borrowed is 10,000. He's going to actually pay interest on that 10,000. So this is going to remain at 500. Then the balance at the end of the year is 10,167, which is this. You add this interest that goes to POL minus the interest is paying. This is the balance here, which you are going to carry forward to year 2. So the interest that goes to P&L, you calculate this 8.85% on this 10,167. You get 900. Then 5%, this is fixed, it's 5% on the principal amount year in, year out on 500. That gives me 10,567. Then year 3, you carry it forward again. 10,567 at the beginning. Then 8.85% on 10,567. That gives 933. Then you would pay 500 naira or 500,000. Then the balance is 11,000, which coincides with the 11,000 maturity amount as given in the question. So from here now, let me add this 3 first. Let's be sure that it gives us that 27. Let me add this 3. Because it's that 27 we are spreading over the 3 years using this effective interest rate. Is anybody
Yes.
confirmed?
Yeah, it
Yeah.
does.
Yes, 27.
Okay, so good. So in year 1 now, is this 867 that will go as finance costs? And you know where finance costs is located in your POL? Is we did what do they call it? We did IS1 on presentation of financial statement where I taught you about that template. So this finance cost always comes after, you know, when you have your sales, cost of sales, gross profit, your admin, your distribution, then you have your profit before interest and tax or operating profit. It's after that you have finance cost, okay, and also finance income anyways. So this will come in there as finance cost in your P&L, while this 10167 will come in under liability as a non-current liability, and it's going to be called financial liability at amortized cost. It's non-current because it's repayable after more than 1 year. That's what makes it non-current. In year 2, 900 POL, then this one becomes current because it's repayable next year now. In year 3, 933 POL, then we'll have our 11,000 that we now have to pay back. And paying it back simply means you credit bank, debit the financial liability. And that is it. It ends there. Okay. So I'm going to stop here for today. Next week, we're going to solve these questions here, these practice questions I have here. And also, we are also going to start with convertible instruments. Then on that note, we'll finish up this one. Then next week, we are going to we'll look at some of these questions here also, just to practice how it is tested in the exam. Then next week, we're going to start looking at, mostly, I will not go to this. There are some 2 topics I jumped, IFRS 16 and also IAS 36. So next week, we're going to start IAS, either of them, any of them, we're going to start them and move as fast as possible. So my target is for me to finish up with you guys in the next, I think in the next 4 weeks, I should finish up. Then after which I'm going to start published. When I say published, I mean all these things you have learned. We'll see how to prepare published accounts with them. So my hope is that I want to solve like 5 diets past questions with you guys, starting from last diet, which is November 2023. I'll solve November 2023, May 2023, November 2022, May 2022, and November 2021. So I hope to solve those 5, and I'll just leave you guys to go and prepare for your exams. Hopefully we won't miss class anymore, and I hope you guys have started reading. I hope so. So for our class to be easy next week, I'm going to share these notes with you immediately now. And read through what I've taught you today. If you have any concerns or questions, reach out to me. I will attend to you. So do you have any questions before I end the class? Any questions?
Are you on the group chat?
Yes.
Okay, so that's fine.
All right, guys. Thank you very much. See you next week. Bye-bye.
Great week, sir. Bye.
Bye.